it's important for us to distinguish between a startup and a normal company or entity. At the same time, it's also important for us to know that there's the culture around how startups are run. Because in the grand scheme of things, a startup is a very hard thing to do. It's a very difficult path. You really need to have committed to this path for you to embark on it, because we sometimes don't understand how hard it can be and it gets. The intention of this series is to allow your business to grow and inevitably become a unicorn. In this podcast, we're going to be trying to use the lens of an avatar or of a story that we learned when we were younger. Depending on where you went to school, you either learned the story of Solomon Grundy or of Simon Makonde. I'd want you to be able to place yourself in the eyes of your avatar, Simon Makonde, who has to go through the 7 distinct stages. Similar to the hero's journey in all the movies and series that you've watched, it's a linear path where the hero needs to be able to go through the nuances of day 1 all the way to day 7, where they become the hero. I want to use this as an allegory to be able to simplify some legal and compliance concepts that have been very hard to explain or even to bring together on account of their complexity. Hello, my name is Kega, the head of legal at Kega and Company Advocates, as well as the head of legal and compliance at Swipe Limited. Thank you and welcome to the premiere episode of Lawtus, Legal for Founders. This is the primer episode where we're going to be providing a bit of an introduction to what we're going to be delving on for this entire season. Essentially, we're going to be trying to explain the entire legal startup lifecycle through the lens of Simon Makonde or Solomon Grundy, depending on where you went to school. But before I do that, I think an introduction is important. It's important for us to distinguish between a startup and a normal company or entity. And so a startup is any tech-based innovative entity that has a strong growth potential and has a disruptive revenue model. So this is the definition that has been offered here in Kenya. And the beauty about it is that it's able to have very important elements to it that I think are able to really create the ethos or the essence of what a startup is, which is essentially a desire to achieve exponential growth or to scale at a very high rate. And so at the same time, it's also important for us to know that there's an ethos or there's a culture around how startups are run. In the same way, there also seem to be some very similar characteristics in terms of how the life cycle is going to proceed, not from a legal perspective, but from an operational perspective. And so what I mean by this is that typically startups will either bootstrap. What I mean by this is that the startup itself is going to be the one that's going to raise the revenue, that the money that is going to be required to fund the startup. But in normal circumstances, a startup is going to require outside investors for it to be able to survive and to scale. And so in that respect, you're often going to have priced and unpriced rounds. And before you do that, you often are going to have what is referred to as a prestage period. So in that respect, let us begin with the first stage, prestage. And so essentially what you do here is try to determine whether your idea is valid. And so you are going to be discussing or contemplating this idea with yourself, if you're a solo founder, or if you have other co-founders, and you're going to be discussing the nuances or the validity of your idea. And beyond that, you're not going to start planning, looking at revenue models, looking at milestones, and also determining whether this is something that you actually want to do. Because in the grand scheme of things, a startup is a very hard thing to do. It often has an arc of around 10 years. And so it's a very difficult path. And you really need to have committed to this path for you to embark on it, because we sometimes don't understand how hard it can be and it gets. And so it's important for me to say that from the onset. At the same time, after you're done with ideation and planning, you get to the commitment stage where you essentially want to do incorporation, and you are essentially thinking about building your MVP, your minimum viable product, which is essentially creating a beta that has just enough features to be able to validate your idea. And the point around creating an MVP is to be able to confirm that your idea, one, is valid, and that there's a subset of users who are interested in using your product or service. And so this essentially happens through the validation stage, where through the beta stage you are able to launch, you're able to open up your product or service to a small number of people. And then from that, you're able to collect data and eventually improve the product. The aim of having an MVP is to establish what is referred to as product market fit. And product market fit is important because it's one of the terms that you're going to hear as buzzwords, especially in the startup ecosystem, but it's an important one because it essentially means that as a startup, you've been able to attract a small subset of users who love your product and are interested in using it and are even champions of your product. So establishing product market fit is one of the initial milestones that a startup often needs to get to. But then also this is on the backdrop of your total addressable market. So what do I mean by this? There's a difference between your product market fit and your total addressable market. Your total addressable market implies the maximum possible revenue customer base you can be able to essentially capture with your product or service as a startup if you're able to achieve 100% market penetration. The reason why this is important is because it allows you to be able to gauge between the opportunity versus what you can be able to capture or utilize for your own benefit as a startup. And so in that regard, once you're able to get to that milestone, then you graduate to the price rounds. The Prestage is going to be for people who are passionate about you as an individual. And typically the people who fund you are three people: friends, fools, and family. But after that, after your product has been able to scale and grow, you're going to have limitations in terms of capital, in terms of leverage, and in terms of strategy. And so in that respect, you often need to have other investors coming in, professional investors coming in, who are going to now help your business scale from the product market fit stage to you having the ability to scale and grow your business. And so after you're able to get here, essentially is when now you begin getting to the Series A rounds. And the Series A round could go all the way to, yes, you can have as many series rounds as possible. But the intention of this series is to allow your business to grow and inevitably become a unicorn. And so I said that in this podcast, we're going to be trying to use the lens of an avatar or of a story that we learned when we were younger. And depending on where you went to school, you either learned the story of Solomon Grundy or of Simon Makonde. And it was a very simple rhyme or poem that was meant to teach us two things: the days of the week, as well as the distinct human life cycle that we often might have. And the unique thing about it is that it's a very linear story where a person is born on Monday and by Sunday they're dead. So the poem goes: Solomon Grundy, Simon Makonde, born on a Monday, named on a Tuesday, married on a Wednesday, got ill on a Thursday, got worse on a Friday, died on a Saturday, and buried on Sunday. And so this represents 7 distinct days, 7 distinct stages, 7 distinct silos. And so using the lens of Simon Makonde, I'd want you to be able to place yourself in the eyes of your avatar, Simon Makonde, who has to go through the 7 distinct stages. I'm calling them 7 distinct stages because, similar to the hero's journey in all the movies and series that you've watched, it's a linear path where the hero needs to be able to go through the nuances of day 1 all the way to day 7, where they become the hero, transforming from the zero to the hero in that respect. And I want to use this as an allegory to be able to simplify some legal and compliance concepts that have been very hard to explain or even to bring together on account of their complexity. And so for the 7 distinct stages, on Monday we're going to be delving into matters to do with incorporation. And we're not just talking about opening up your company, we're talking about the needs of an African founder. And so Lawtus is meant to provide legal insights for founders who are in Kenya, Nigeria, South Africa, as well as founders who would want to have a presence in Delaware, specifically in the US, or Nevada, Wyoming, or some of these other jurisdictions that have begun having a favorable environment for founders. The reason why this is important is so that we can be able to know whether that is going to be important for us, where you should incorporate, and why that is going to be important for you. On Monday as well, we are going to be looking at how you're going to obtain a tax identification number in the different jurisdictions that you're going to belong to. And lastly, we're also going to talk about how to obtain a bank account. Essentially, on Monday, we want you to be a going concern, an entity that is able to get into contracts, employ people, and essentially operate as a separate legal entity. On Tuesday, Simon Makonde is named, and here we are going to be trying to do what is referred to as post-incorporation. And so here we're going to be trying to protect the three things that matter to your company: your people, your ideas, and your intellectual property. And so specifically, we are going to be delving on matters to do with the founders of the shareholders agreement. This is going to be your Bible or constitution that is going to guide you as shareholders and as founders on how you're going to operate and how you're going to be able to run your company. Specifically, nuances such as who's going to have what powers, the cap table, vesting, and things like that. At the same time, on Tuesday, we're also going to delve into matters of a non-disclosure agreement. And so this is where you try and protect the confidential or proprietary information of your startup. In this respect, you're going to cover both unilateral and mutual non-disclosure agreements. And then lastly, on Tuesday, we're also going to cover confidential or property information and invention assignment agreements, which is essentially a contract that allows the founders to be able to assign the IP that they generate to the company, because the company needs to be the bona fide owner of all the assets that are generated by the founders and the employees. Solomon Grundy gets married on Wednesday. And on Wednesday, we're going to delve into matters of hiring, whether you're going to be hiring employees or whether you're going to be hiring consultants. What is the difference and why does it matter? At the same time, we're also going to be looking at matters to do with employment stock options, as well as whatever incentive plans that you might want to give your employees. And lastly, we're also going to be looking at the non-disclosure agreement. And so as we proceed on our journey through the lens of Solomon Grundy, we are also going to be looking at Thursday, where Solomon Grundy got ill. And here essentially we're going to be trying to look at some of the commercial agreements that you need to be able to survive as a startup. Your service level agreements, if you are a SaaS organization, your terms of use, things to do with non-disclosure agreements in the event that you're getting into a deal with some of the people that you're talking to, licensing agreements, joint ventures, partnership agreements. So this is the day that you're going to be looking at the nuts and bolts of your startup running. Solomon Grundy, Simon Makonde got worse on Friday. And so here we're going to be looking at some of the tax and statutory obligations that you need to deal with. So we're going to deal with some of the nuances that, for example, the Kenya Revenue Authority is going to demand from us. We're going to look at some of the requirements that the IRS is going to demand from us. And in the event that we have some very sensitive issues that we might need to discuss, we are going to discuss them on that episode. We're also going to look at some of the statutory things that you might need to operate. So, for example, a county license if you're operating in Kenya, things like that. And then on Saturday, Solomon Grundy or Simon Makonde dies. And here we're going to be looking at fundraising. And so these are the nuances of trying to get capital, leverage, and strategy from professional investors. In this case, it's mostly going to be VCs. And so this is when you're trying to essentially grow from, for example, the product market fit stage, or you've just gotten to your MVP and you're trying to scale your business. And so on Saturday, we're going to be looking at some of those nuances, things to do with the data room and how to manage them, and some of the documentation that you need to have on hand. And then lastly, Simon Makonde gets buried on Sunday. And so here we talk about issues to do with exit and legacy. Typically, this is mostly going to happen through an IPO or through private equity. And so we're going to be delving on matters to do with how your startup is going to be able to cash out. And so welcome to the first season of Lawtus Legal for Founders, where we're going to try and break down the startup legal life cycle for founders in Africa. Join us on Monday. Monday is calling. We're going to be delving into matters of incorporation.